Hello everyone, welcome to FinTalks. This is Dr. Harikarri, PhD in Finance, having 22 years of experience in teaching and also industry. In my previous video, Capital Budgeting Part 1 video, I explained about one of the traditional method, that is payback period method. Now in this video, I am going to explain in detail another traditional method, that is ARR. Accounting rate of return method or average rate of return method. This is another traditional method used to evaluate the capital budgeting proposals, capital budgeting alternatives. So basically ARR is the percentage of average profit after taxes on average investment or original investment. We can calculate this percentage of average profit after taxes either on average investment or original investment, but average investment is preferable, is accurate. So as I told in previous video, for all the methods, cash flows means cash flow after taxes, but for ARR method, accounting rate of return method, cash flows means here profit after taxes are considered. So the formula to measure the ARR is average profit after taxes divided by average investment multiply with 100. That is ARR is the rate of return percentage. That's why we will multiply with 100. So how you will get average profit after taxes? Average profit after taxes equal to total profit after taxes divided by number of years. And how you will get average investment, where average investment equal to original investment, that is cost of the investment divided by 2. That is the general formula. But in question, if the information about scrap value or additional net working capital is available, then you have to use more another formula. You have to use clear formula. What is that? Average investment equal to original investment minus scrap value divided by 2 plus additional net working capital plus scrap value. These two values has to be added back to get the average investment. If these values are available in the question, we use formula. If they are not available, then there is no need to simple formula. We will use original investment divided by 2. And coming to the profit after taxes, if they are available directly profit after taxes, we can substitute the values in formula, no issues. If profit after taxes are not available, then you have to measure them. You have to calculate, you have to extract the values of profit after taxes from the values given in the question. Now let us see an example practical problem I am going to solve in front of you. Different models I am going to solve, one project, single project, double project. And coming to the decision making, decision criteria, accept or reject. If it is only one project, single project, you will compare the ARR of the project with the standard ARR of the company. If the calculated ARR is more than the standard ARR, the project should be accepted. If the calculated ARR is less than the standard ARR, then the project should be rejected. That is the decision criteria. In case of more than one project, 2-3 projects are available, then how you will make the decision? You will calculate the ARR of all the projects and then compare, and the project which is giving maximum highest ARR should be accepted and other should be rejected. That is how we will make the decision in this ARR method. Let us see an example I am going to solve here. So what is the example? A company is considering an investment proposal to install a new machine. The project will cost 50,000 rupees and will have a life and no salvage value. Tax rate is 50%. Profit after taxes are as follows. 5 years, 5 values. Evaluate the project using ARR. ARR stands for average rate of return or accounting rate of return method. So here if you see, cash outflow, cost of the project is 50,000, and coming to the cash inflow, profit after taxes are given directly. For the purpose of calculation of ARR formula, what we need? Profit after tax only. And in this question, profit after taxes are given directly. So we can use the direct formula and you can substitute the values in the formula and you can calculate ARR here in this one. So what is ARR formula? ARR is equal to average profit after taxes divided by average investment and multiply with 100. That is the formula ARR. And what about the average profit after taxes? Profit after taxes is equal to total profit after taxes divided by number of years. And if you check here, what about the total profit after taxes? Add the PAT of all 5 years. 5 plus 6, 11 plus 9, 20 plus 30, 50, 30 plus 20, 50. So total of these 5 values, 50,000. And what about the average investment value? Equal to, the formula is original investment divided by 2. And here there is no scrap value, no additional working capital. That's why we use simple formula. What is the original investment? 50,000 divided by 2, that equal to 25,000. So you have both the formulas. Now substitute, you have both the values, numerator and denominator. Now substitute the formulas. Numerator, average profit after taxes. Average profit after taxes, total profit after taxes divided by, number of years, 5. That equal to 10,000. So average profit after taxes is 10,000 and average investment 25,000. Now ARR equal to average profit after taxes divided by average investment and multiply with 100. Multiply with 100. That equal to, so 10,000 divided by 25,000 multiply with 100, 40%. The average rate of return, accounting rate of return percentage for this project is 40%. Generally, decision making means we will compare this ARR because it is a single project. We will compare the ARR with the standard ARR of the company. If the ARR, calculated ARR is more than the standard ARR, accept the project. Otherwise, reject the project. That is the decision criteria. But here in this question, standard ARR is not available. Just only we calculated the ARR. That's it. I hope you understand. Now come to the second model. Another model. This model is another problem. Example 2. The machine cost 100,000 and has a scrap value of 10,000 after 5 years. Net profit before depreciation and taxes for 5 years period are to be projected that 20,000, 24, 30, 26, 22. Taxes are 50%. Calculate accounting rate of return. So first of all, accounting rate of return is the percentage of the profit of average profit after taxes on average investment. If you want to calculate average investment, we need the original investment. Yes, original investment is available 100,000, and scrap value is also given. So we will use the scrap value also in the formula. We will use scrap value also. And next, what is that one? Profit after taxes. Here profit after taxes are given directly. See, net profits before depreciation and taxes. We need profit after taxes, but here it is given profit before depreciation and taxes. This is not our value, required value. So we have to measure, we have to calculate profit after taxes from these given values. How we will calculate? Let me see. This is working notes. First we have to keep it ready. So how many years? I think 5 years. So one more row, I will make one more row, insert below. So one more row I made, and this is the values given. What is in the question they give? Profit before depreciation and taxes. That means so profit before depreciation and taxes is given. How much is given? Year 1 20,000, year 2 24,000, and year 3 30,000, year 4 26,000, and year 5 22,000. This is profit before depreciation and taxes. I mean depreciation, both taxes are included. Now first you have to minus depreciation. First we need depreciation. How we will get depreciation value? So we have to calculate here depreciation. How we will get depreciation here? Let me calculate here depreciation. Depreciation is equal to cost of the asset, cost of the project, or cost of the asset, whatever may be, cost of the mission minus scrap value divided by number of years. That means equal to, what is the cost of the mission? Cost of the mission 100,000, 100,000 minus scrap value how much? 10,000 divided by life of the project, that number of years is 5 years. That equal to 100 minus 10, 90,000 divided by 5. That equal to 18,000. Value of depreciation per annum is 18,000. 18,000. So depreciation is, assuming straight line method, remains same every year, 18,000. Now what we will get? Profit before tax. How we will get profit before tax? It is profit before depreciation and tax minus depreciation. 20,000 minus 18,000, 2,000. 24,000 minus 18,000, 6,000. That is profit before tax. How we will get? Profit before depreciation and taxes minus depreciation will give you profit before tax. 30 minus 18, 12,000. 26 minus 18, 8,000. 22 minus 18, 4,000. Profit before tax. And next to tax at the rate of, what is the tax rate? 50%. So we have to calculate tax at the rate of 50% on profit before tax. This value you have to calculate tax 50%. 50% on 2,000, 1,000. 50% on 6,000, that is 3,000. 50% on 12,000, that is 6,000. 50% on 8,000, that is 4,000. 50% on 4,000, that is 2,000. Profit before, is the tax at the rate of 50%. And now the final value, what we need, profit after taxes. How you will get profit after tax? Profit before tax minus tax, profit after tax. 2,000 minus 1,000, 1,000. 6,000 minus 3,000, 3,000. 12,000 minus 6,000, 6,000. 8,000 minus 4,000, 4,000. 4,000 minus 2,000, 2,000. So I'm explaining again. They gave in the question profit before depreciation and taxes. First we calculated depreciation. This is the formula. Profit before depreciation and taxes minus depreciation will give profit before tax. Profit before tax minus tax will give profit after tax. And tax is calculated at the rate of 50%. So now we have the cash flow, that is profit after taxes is available. And next what we need, average investment. So first of all, formula. What is the formula of ARR? ARR is equal to, already I calculated formula here. What is the formula? Average profit after taxes divided by average investment. Next, how we will get average profit after taxes? Total profit after taxes divided by number of years, that equal to, how we will get total profit after taxes? This column, profit after taxes, add all of them. 1,000 plus 3, 4 plus 6, 10 plus 4, 14 plus 2, 16. 16,000 divided by number of years, 5, that equal to 16,000 divided by 5, that is 3,200. Average profit after taxes 3,200. Next what I need, average investment, but here scrap value is there. Even the scrap value is there, formula will change. Original investment minus scrap value. Original investment minus scrap value divided by 2. Then again you have to add back, after that you have to add back scrap value. Here additional networking capital is not available. If additional networking capital is available, then we have to add additional networking capital also. So original investment, let me start. Original investment, how much cost? 100,000. 100,000 minus scrap value 10,000 divided by 2, and then plus scrap value. Scrap value is plus, my dear, plus scrap value. Scrap value how much? 10,000 only. Scrap value, or it is also called as residual value. It is also called as terminal value, that is value at the end of the life of the asset. 100 minus 10, 90,000. So 90,000 divided by 2 plus 10,000, that equal to 45,000 plus 10,000, that equal to 55,000. Average investment is 55,000 rupees. Original investment minus scrap value divided by 2. 100,000 minus 10,000 divided by 2, that is 90,000 divided by 2, that is 45,000 plus scrap value again back, add back 10,000, so 55,000. So now in order to calculate whatever we require, numerator average profit after taxes is ready. Denominator average investment is also ready. Now substitute the values in the formula. What is the formula? Average profit after taxes 3200 divided by average investment, that is 55,000, multiply with 100, that equal to, what is that one? 3200 divided by 55,000 multiply with 100, that is 5.82, 5.81 percentage. So the ARR, accounting rate of return for this project is 5.81. If you want decision, if you want rate, means you have to compare the ARR, calculated ARR with the standard ARR of the company. But here standard ARR is not available in the question. So just we calculated ARR, that's it. And here profit after taxes are not given directly. They give profit before depreciation and taxes. So first you minus depreciation, then you minus tax, you got profit after taxes, average you calculated. And average investment also use this formula. Once you both the values, substitute the values in the formula ARR, and the ARR of the company, this project is 5.81%. This is another model. Example 2, how to solve this one. I hope you understand this one. And another model I am going to explain you. Let us see. What is that model? Two projects. X Limited is considering the purchase of a mission. Two missions are available, E and F. Mission E and mission F. The cost of each mission is 60,000. Each mission costs 60,000. So cost of the mission, cost of the project, cash outflow, cash outlay, cost of the investment, initial investment, all are same only. Each mission has an expected life of 5 years. Net profit before tax after depreciation. Read carefully. Before tax after depreciation, that means depreciation is already minus, already deducted. Before tax means tax is still not deducted. During the expected life of the mission are given 5 years to mission, 5 years to mission E, mission values, given values. Following the method of average return on average investment, ascertain which of the alternative will be more profitable. Average rate of tax may be taken as a 50%. So what is the formula for ARR? You have to calculate ARR separately for mission E and mission F. Calculate ARR of mission E, ARR of mission F, and then compare for decision. And to make the calculate the ARR formula, what we need? Numerator, average profit after taxes. Profit after taxes are not available, so we have to calculate profit after taxes by preparing a table. What is given in the question? Profit before tax and after depreciation. So depreciation is already minus, no need to do again. Only just you have to minus taxes to get the profit after taxes. What about the average investment? Original investment divided by 2. If there is any scrap value or any additional net working capital, we will adjust that also in the formula. But in this problem, there is no scrap value, no additional net working capital. So we will use simple formula. Original investment divided by 2. So let us start first with the mission E. Year. How many years are there? 1, 2, 3, 4, 5. And next, what is the given value? Net profit after depreciation, before net profit before. So before net profit before tax after depreciation. That means here depreciation. Depreciation is already minus. Only tax is not deducted. So we will first let me write here values. 15,000, 20,000, 25,000. I'm calculating for mission E dear. 25,000, 15,000, 10,000. So this is the net profit before tax after depreciation. It is nothing but we can call it as a profit before tax. We can before tax. Now tax rate of at the rate of 50%. Average tax 50%. So from this value calculate 50%. 50% on 15,000, 7,500. 50% on 20,000, 10,000. Sorry, 10,000. 50% on 25, 12,500. 50% on 15,000, 7,500. 50% on 10,000, that is 5,000. Now this is profit after tax, that is PAT. This is what we need, but in this question what they give is PBT. So from PBT I minus tax, then I got profit after tax. How? Now this column is profit before depreciation, before tax after depreciation, that is PBT. From this column we minus tax. 15 minus 7,500, 7,500. 20 minus 10,000, 10,000. 25 minus 12,500, 12,500. Because tax is 50%. So if you half minus, the remaining will be 50%. That's why very easy we are calculating. Since the tax rate is 50%, it is easy to measure, easy to calculate. So profit after tax is ready. Now what is the formula? Write down the formula. Let me take formula from here. Average profit after taxes divided by average profit after taxes divided by average investment, multiply with 100. Average profit after, how you will get? Total profit after taxes divided by number of years. Okay. What is the total profit after taxes? This is the column. Total profit after taxes. Add all these 5 values. So 7,000, 15, 25, 30, 42,500. I got 42,500. 42,500 divided by how many years? 5 years. Let me calculate again. 17, 5, 20, 30, 37, 42,500. Okay. Now the formula is 42,500 divided by 5. That is 8,500. Average profit after taxes, numerator value is ready, 8,500. What about denominator? Average investment. Do you have any scrap value here? No scrap value, nothing. So direct formula. What is the direct formula? Let me take the formula here. Here average. This is the formula. Average investment divided by, original investment divided by 2. What is the original investment cost? Each project 60,000. 60,000 divided by 2, that equal to 30,000. So now ARR equal to, I have the numerator average profit after taxes and I have the denominator average investment. Both are ready. Now substitute the value in the formula. Average profit after taxes 8,500 divided by average investment 30,000. 30,000 multiply with 100, that equal to 8,500 divided by 30,000 multiply with 100, that is 28.33%. 28.33%. The ARR, average accounting rate of return for the project E, mission E, is 28.33%. Here no scrap value, no additional working capital. That's why we use simple formula, original investment divided by 2. But coming to the profit after taxes, not available directly. What is given in the question? Profit before tax after depreciation. It is nothing but profit before taxes. So from this, calculated tax at the rate of 50% and minus it. Then automatically you will get profit after tax. Since it is tax is 50%, it is easy to calculate. Easily you are getting the values 50-50. And substitute the values in the formula 28.33. In the same way, I am going to calculate for mission F also, and then we will write down the decision. First column, so let us go to the mission F here. Let me go to mission F, and first column is year column. Same, all headings will be same, because mission F also what is given? Profit after depreciation, before tax after depreciation is given, that is nothing but PBT. How much is given for F? 5,000, 5, 15, 20, 5,000, 15,000, 20,000, 5, 15, 20, 30, 20. 30,000, 20,000. So profit before tax after depreciation, nothing but profit before tax. Calculate tax at the rate of 50%. 50% on 5,000, 2,500. 50% on 15,000, 7,500. 50% on 20,000, 10,000. 50% on 30,000, 15,000. 50% on 20,000, 10,000. Profit after tax. How you will get profit after tax? Profit before tax after depreciation, that is PBT, minus tax. Profit after tax. Since the profit is only 50%, since the tax is 50% rate, it is easy to calculate the balance value. 5,000 minus 2,500, 2,500. 15,000 minus 7,500, 7,500. 20,000 minus 10,000, 10,000. 30,000 minus 15,000, 15,000, 15,000. 20,000 minus 10,000, 10,000. So ready. Now substitute the values in the formula. Again take the formula. What is the formula? ARR, average rate of return, or accounting rate of return, equal to average profit after taxes divided by average investment, multiply with 100. How you will get average profit after taxes? Simple, that is total profit after taxes. What is the total profit after taxes? This is the total of all these values. 2,500 plus 7,000, 10,000, 20, 35 and 45. 35, 45. So 45,000 divided by number of years 5,000. That is equal to how much? 9,000 is the average profit after tax. What about average investment? Do we have any scrap value in working capital? No, nothing. So simple formula. Average investment equal to original investment divided by 2. What is the original investment? Mission F cost also same 60,000 divided by 2, that equal to 30,000 only. So same formula. Now let us ARR equal to average profit after taxes 9,000 divided by average investment 30,000. I'll keep this in the brackets. Multiply with 100, that equal to, let me take the calculator and do it. 9,000 divided by 30,000 multiply with 100, that is 30%. exactly 30%. So ARR of the mission F is 30%. ARR mission E is 28.33%. When it is two projects, you have to compare both of them, and the project which is giving maximum ARR should be accepted. Mission E is giving 28.33, mission F is giving 30%. So little more is there. So that's why the decision is project F should be accepted as its ARR is maximum or high compared to project X. Project E. Compared to project E, project F is having more maximum. That's why it is so that's why we are accepting the project F should be accepted. This is the decision. So when two projects are there, you compare the ARR of both the projects, and the project which is giving the highest maximum ARR should be accepted. In this question, project F is the highest one, so project F should be accepted. This is another model here, and now this is the ARR method. Here profit after tax is not given directly, we calculated from the values given in the question. So this is one of the traditional method, ARR method. Other methods are there, but these two are the popular one. And the traditional non-discounted cash flow method, payback period method, and ARR are the two methods. In my previous video, part 1, I discussed about the payback period method. In this video, I discussed about the ARR, accounting rate of return or average rate of return method. I hope you understand. If you have any doubts, you can send me an email or you can do in the comments. And in the next video, in detail, I will discuss about the second method category, discounted. Modern methods are discounted cash flow method or time adjusted methods used to evaluate the capital budgeting proposals. That is net present value method, profitability index method, IRR, internal rate method. These three methods with different practical examples. By solving practical examples, I'll continue that in the next video, part 3. And also I will try to cover maximum different types of models from the different previous examination papers from the various levels. I will cover there, and I will try to solve as many models as possible dear. I hope this understand for you. If this is useful for you, then definitely please subscribe and share my channel. Thank you very much. Have a good day from Dr. Hari.